The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Matt Justice here for Tackle Trading. Recently got off a very, very nice vacation. Spent some time down in San Diego, down in Disneyland as well, and I'm back at it, ready to record some videos today and get the activity going again. I know many of you are waiting on some videos, so we'll be recording some over there at the Tackle Trading website. Noah's recorded some today, Tim's recorded some today, and we got just some amazing things working really, really well over there. So let's get at the first video today. I got an email from a student that's looking to do an iron condor. Now, what an iron condor is it is a credit spread that basically is a four-legged trade. We're going to sell out of the money options. We're going to buy deeper out of the money options. The net result will be a credit. That credit is paid to us. It's a high probability trade, and it's a trade that a lot of people really, really love. Well, what this trade was on the S&P 500, and we're looking at $SPX right now. So what the student did is they sold the 1830 strike price in November all the way down here, and then they sold the 220 strike price right there, right above a resistance level. Now, when I'm looking at this trade, the first thing that stands out to me is the ranges. The trade has a lot more range to the downside than it does to the upside. For example, you got 120 points currently, and when he made the trade this morning, it was actually a lot worse. It was like 140 points to the downside versus right around 50 points to the upside. I like to treat iron condors as neutral as possible, unless I'm rolling into it. If I'm legging into it, that's one thing. But this is just put on. I think there's a couple mistakes here. Number one is the range to the upside versus downside is uneven. You got a tremendous amount more range to the downside than you do to the upside. And the marketplace, even though I'm a little concerned about it, as I've done in other recordings, in the newsletter and whatnot, it has shown tremendous resiliency throughout the better part of the last year. So, if this goes up past and breaks out of 210, your range at 220 is going to be hit and you're going to lose money. And so what I would first like to see is to make these two lines, the ATR difference, the ranges to the downside and the upside, make them as evenly possible. And one of the ways you can do that is simply by looking at the deltas that you're selling. Make sure that you're selling a delta into the 1-0 range, 1-5 range. Have a high probability trade. Make sure they're fairly equal over there. But in terms of just the trend, in terms of the trade, I like the trade from a trend perspective. I like the trade from what you're trying to accomplish perspective. The only thing I don't like so far in this trade is the ranges to the upside versus the ranges to the downside. Let's make those as evenly as possible. Now let's go ahead and look at the strike prices in terms of ROIs. Once again, we got the November strike prices. We're looking at the 1830. So if we right click, sell iron condor, it's going to bring up an order form down here, and I believe there was 2 contracts on this one. We're going to have to change our call side to the 220 right there, and we're just going to do the next strike price lower at 225 right there. All right, so here we got a 235 credit on a basically, let's make sure I got this right, on a $530 buying power effect. This, from a numbers standpoint, this is an awesome trade from a numbers standpoint. Because it's such a wide index, I might want to widen that out to the 230, and I'm going to widen this one out to the 1820. So instead of a $5 spread, I'm looking at doing a $10 spread here, and now we got 380 credit on a $10 margin. So we're looking at about $760 credit on a $1,240 buying power effect. That is, from a number standpoint, an awesome trade. Looking at the liquidity here, 2,000 open contracts, 114 volume. That meets our minimum standards of 1 in 100. On the put side, we're looking at volume of 166 and open interest of 2,900. Both of those requirements are met, which basically means it's liquid enough for us to get filled into the trade. So what we're going to do now is just confirm and send that into the market and hang out while we try to get filled in that trade. So looking at the trade, really like the numbers, like the ROI, like the credit received. I like your ranges outside on the put side. What I would do is, because it's such a fantastic credit, instead of selling this 220 and making this iron condor aggressive, get up here into the 2050 range. You can still get a great credit. You can still, get like literally 18 to 20% ROI on a 90% probability of success type numbers. But you're evening out your range, number one. So if it does break out, you got time to adjust if you need. Hope this helps in terms of the iron condor. Hope it helps in terms of understanding the ranges when we're selling an iron condor. And we'll get some more videos coming out there. Matt Justice for Tackle Trading. Have a great day.
Get in the game. www.tackletrading.com